Hello YouTube, this is Steven with On My Way to Fire, a channel about early retirement and all things investing. Alright, and so in today's topic we're going to talk about July's performance so far for the covered call funds that I hold in my Roth IRA. So just to recap guys, I'm in about 10 different covered call funds through various issuers. They are Defiance, Yield Max, and Roundhill. And what they do is they pay a weekly dividend based off either a single stock, so I have like Nvidia, Palantir, Amazon. There's some for crypto, Ethereum and Bitcoin. I have gold, and it's actually gold miners. And then I have a couple other ones that are related to either an index or a group of stocks, one for NASDAQ and one for small cap index. So what these funds try to do is they capture a premium for selling covered call options. Now you could do this yourself, but you'd have to purchase the options contract and be willing to hold it. In this method, you're actually paying a provider to do the trading for you, and as a result, you get a weekly dividend. So I got into this about a year ago and really followed it closely on Reddit and followed the stocks and, just got immersed in the world of what are covered call funds. And so I noticed that there were some already. There's one called GEPI, G-E-P-I. That's issued by JP Morgan Chase, but that's a monthly payer. So these other ones that I have pay weekly. And so my goal has been to build each fund up to about $3,000 to $3,500. So $30,000 to $35,000 in these funds, and let the dividend income reinvest and see how they do. And so now we're getting to the period of, we're closing in on that year. I'm probably at 7 to maybe 8 months to as high as 10 months in some of these funds. And so what I've noticed is the prices have declined over the last year, but I've been issued dividends week after week and really gained some insight into how they work and the mechanics of these funds and what to expect and how to trade them. So what I'm doing here is we're going to do the monthly update and talk about how much I have invested and how it's performed. So far for the life of trading these type of funds, I really should say investing because I'm not really trading them. I do occasionally sell, but for the most part I'm just accumulating shares. So I'm investing in them. I've received $3,239 in dividends. So that's quite a bit of money. Now, in some cases, the early dividends were purchased at the higher price, so it's actually declined in terms of the value of what I received. But it, accumulates, and all those shares, I'm up to over 100 shares in some of these funds. They're now paying between $25 and $40 a week in dividends. So, it's a trade-off. There's a natural mechanic to these funds of what's called NAV erosion, where the net asset value, which is the NAV, of the stock that it is, it's, let's put in, for example, let's say Palantir. Palantir got as high as $200 within this last year, but went all the way down to like 108 recently. So that fund in particular has gone down quite a bit, and the dividends dropped a bit as well. But because I continue to buy these shares, I've actually experienced a rebound of somewhere between 20 and 30% on the share price, and the dividends are starting to come back. Now that's having a little bit of a rally. I think it's about 130 right now. But overall, the Palantir has gone down quite a bit from the $200 range. So the way these funds work is if the stock, let's say, did get back to that $200, it might not get to the stock price that related to that covered call fund at that time because it's had to pay out dividends all along the way for all those weeks. So really, you're trading the upside potential for a consistent stream of dividend income. So I'm capping it off at about $3,000 to $3,500, and then I want to decide, do I want to maybe trade shares and try to make money off dips, or be a long-term investor and try to let those dividends really compound? Now, I don't think that's really going to work long-term, so I really got to give myself about 1.5 years to a 2-year time frame to figure out an exit plan on how to get out of these funds. But for now, I'm enjoying the ride and having fun with it. So let's get into the numbers here. So last month, I was at a negative principal cost of $450. And so that means everything I invested with the dividends factored in, I was at a net loss of $450. This month, I am now at $499 negative. So only a $50 difference, but that doesn't tell the whole story. We have had insane volatility since the SpaceX IPO launched. And all these channels that I follow, Bloomberg, CNBC, MarketWatch, they really talk about liquidity exiting the market. And so what ended up happening leading to the SpaceX IPO is a lot of people sold their stocks, and that could be Palantir, Nvidia, other tech stocks really selling off because they had significant gains at that point, and they wanted capital to put towards the SpaceX IPO. Now, the SpaceX IPO is its whole other thing. It issued at $135 if you actually bought the SpaceX stock, but they also have covered call funds related to SpaceX now that I am completely staying away from. The price of the SpaceX, I think it went up to about $170 within the first day, got as high as 200 and something, and it came back down to earth, if you want to use a bad pun. But I think it's back to like 138, so it's essentially the same price as when it was issued. And I think a lot of these people that bought it after market, when it actually started trading, if they didn't get the IPO at 135 issued from the company, they overpaid for it, and now it's pretty much at the IPO price. And so what's happening there is there's a lockup period for SpaceX executives and insiders to be able to sell their shares, and I think just the mania towards it just fizzled out rather quick. So within about 3 or 4 days, that price was already starting to come down. But that's a little off topic. But the main idea was there are SpaceX covered call funds, and I've stayed away from them because the price has been extremely volatile, and I haven't tracked this week, but they were going down quite a bit from when they were issued, so I'm not going to even bother trying to buy those. So the takeaway I've gotten is the single stock ones really are extremely volatile. The prices will swing around all over the place, and I continue to say you got to be nimble. I got to have cash in that account every so often. I have somewhere between $200 and $300 worth of dividends that deposit that aren't investing in other stocks, and I'm using that money to buy some of these covered call funds as well as new deposits. And so every year there's a maximum limit to the Roth contribution. So since I'm under 50 years old, that limit is $7,500 this year. Last year it was $7,000, and so they adjust that for inflation. But I use that account because it's tax advantage. That money that's earned within the Roth IRA is never taxed again. So that's how that account works. So anyway, back to the topic at hand here. Okay, so $450 loss in June, and we're now at a $499 loss. But what's interesting is just in the last couple days, there was a point probably about a week and a half ago, I was down about $1,100 to $1,200. These stocks were experiencing extreme volatility, and I might have been on an ex-dividend date where the money had been deducted from the stock price, and I was going to get paid back within the next day or two. But man, I built an Excel tracker that has my purchase prices, my dividends, the current price, and relative performance. And so during that downtime, I was able to put a little bit of money to work by buying more shares on the dip. The previous month I was at $17,500 invested, and this month I'm at $19,200. So pretty fair amount, almost $2,000, $1,700 I guess. But it just takes time. Like I said, I only have about $300, $350 maybe at most from new dividends from other stocks. So the way I was able to get to that other $1,000 in that case was selling other winners within the Roth IRA. So I've had some good luck with REITs and other oil and gas companies in the last few months. So I continue to rotate on those stocks, occasionally put some of that money into the covered call funds. And it's worked out pretty good. But at the same time, I'm banking on the performance of these covered call funds coming back to some extent. So a $1,200 loss a few weeks ago did have me a bit concerned because, that was a pretty substantial, drop in investment. It was probably close to about 8% of what I have in it. And it lasted for a couple days. But really within the last few days, it's gone from like negative 700, negative 600 to today at close. A lot of these stocks rallied, and it got me back under a negative $500. And I have some dividends coming in the next couple days. So, there's a potential I could finish the week here at like negative 400 or possibly even less than that. So it's coming back pretty well. But I have to be disciplined with buying and selling. So I've come up with a system here, either a 3-1 or a 5-2 rule. And what that means is I'm going to buy 3 shares of a particular covered call fund, the same one, let's say it's the NVIDIA one. And for every 3 I buy, I need to be selling one of those when it comes back. So if it continues to go down, I'll buy some more. But the mentality is, if I only buy 3, we sell 1. If I buy 5 or I buy 10, I increase that number. If I buy 5, I sell 2. If I buy 10, I sell 4. And just keep doing it that way. But the 3-1-5-2 is kind of the basic rule because, I have to come up with the cash to buy these shares. And the NVIDIA Roundhill one, MVDW is the symbol, I think it's trading at about $37 right now. I was able to get shares a few weeks ago for about $33 to $32. So that goes to show you how volatile these are. You can make well over 10% on the share price when the stock does come back. It is a bit capped though, because if that stock goes back to the 52-week high, as I said, the stock will not get to like 50 bucks. It'll probably stall out somewhere in the 40s. So that's fine with me. The dividends continue to come in. So kind of the goal that I want to keep in mind is let the dividends reinvest for about a year, and those dividends compound over each other, because I'm getting an extra fractional share, maybe 0.7 shares, maybe 1.2 shares. Just depends on what the stock price is at that time and what the dividend is. And, these dividends fluctuate. So a really good example with the NVIDIA one, I had dividends paying, like between $25 and $35 a week. And then a bad dividend payment, when it really went down, it caught up the week after. That's when the dividends kind of relate to the stock's performance. The dividend was like less than $10. This week it was $35. So it was a good payment on NVIDIA. So over the course of the month, I made over $100, but one of those payments was only $10. So you have to be reasonable with your expectation and understand how these work. And once you've been in them a while, you'll see how they operate. And so what I've seen other people do on Reddit, what they were talking about was buying somewhere between $5 and $25, even $100,000 of some of these covered call funds all at once, and just letting the dividends come back. And they were not rebalancing and buying it again. They were not trading it. They wanted to see how much money they could get back, and basically what residual value was left of the shares after maybe 6 months or a year, and they get to a point of what's called house money. So let's say they put in $100,000 in the NVIDIA fund, and it had its ups and downs, but it paid the dividends. Maybe over the course of 14 or 18 months, it paid back more than what they paid in, and it still had a value of like 20 grand. Then technically the 20 grand that's left is the profit, but it's continuing to pay. So the longer they stay in it, they're getting that dividend income. And if the stock continues to reach new 52-week highs along the year, the stock may actually rally a little bit. So it all depends on how you want to approach it. To me, that's an extreme risk take to do something like that. So I'd rather just go slow and steady, let the dividends do the work for me, and see how they perform. So 32.39 in cumulative dividends is pretty cool. But if the stocks, what this negative 4.99 is telling me is it didn't make up for the difference. It would have had to have earned another $500, right? It would have had to earn about $3,800, $3,750 for me to at least break even. And then from that point, it would be house money. So that's the trouble with these funds. If the stocks have a lot of downward pressure, you're not going to get paid the dividend as good as it should be, or at least of what you've seen in the past. And then on top of that, the price goes down. And so it's a difficult juggling act. And so what I think I'm going to do is focus more on the NASDAQ and the small cap funds, because they're performing, and the dividends aren't quite as high. It's not as sensational, but the NAV erosion and the price stability is a lot better. So that's pretty much my approach with that. And, I may cut the experiment a little short. I'm at 19,200 right now. I may cap this off at like 22,000 to 25,000 instead of getting to the full 35,000. I'm at a limit so far of just over 6,000 for the year deposited into the Roth. So I really only have another 1,500 I could deposit on my own. And I don't really have much more that I could sell to raise cash within the 401k, within the Roth until next year. So we'll just have to wait and see. But let's say I do get into that habit of buying 3 or 4 shares of some of these stocks and selling 1 or 2 as the price comes back. I can keep recycling that money, and the dividends continue to grow week after week, because net, effectively, I have more shares week to week, right? And even if I do sell a couple shares from it, it's still compounding with the dividend reinvestment. So it gets all a little complicated, but basically you have to be patient enough for these stocks to come back and start working for you, and not overthink it and just let the market do its thing. So I appreciate you watching, following the journey. I'm going to see where we can get next month. The goal, I want to be positive for August. I'm trying to do this a couple weeks into the month so that I can see how it's come back from a month end versus, like window dressing at the quarter, when stocks tend to have a little bit better performance. And, these companies come out with their prospectus. They publish it, every 3 months. So it was June. So I figured, let's keep this on the maybe 2 weeks into the new month. That way I can track it a little bit more accurately and have these stocks go through different phases. But I appreciate you watching. If you like the video, please give me a like and subscribe, and we'll see you in the next video. Thanks, guys.